All right, continuing on in our discussion of the considerations of the risk of material misstatement due to fraud. We're still in AUC section 240, and up until now, we have first talked about discussing with management and those charged with governance and our engagement team about their policies and risk related to the material misstatement due to fraud. And then then we discussed assessing that risk of material misstatement due to fraud at the entity, and now we are going through our developing our procedures to respond to those assessed risks of material misstatement due to fraud. And in the last video, we looked at fraud at the financial statement level. And for this one, we will look at the assertion level for our risk of material misstatement due to fraud. And the assertion level would be at the level of individual accounts or asset classes or disclosures, as opposed to being at the overall financial statement level. So now we're in the trees of the risk assessment, rather than looking at the forest. So here at AUC section 240.30, it says that in accordance with section 330, the auditor should design and perform further audit procedures whose nature, timing, and extent are responsive to the assessed risk of material misstatement due to fraud at the assertion level. So that means that if in the prior sections and videos where we discussed those, we determined that there's a risk of material misstatement due to fraud in a particular assertion, then we need to design and perform audit procedures to mitigate our risk in those particular assertions. So we have some explanatory material here in section A43 through A46. So let's go down there and see some more details of how we can accomplish this requirement. Okay, so now we're down in the explanatory material. So as we saw in the requirement, we're supposed to develop responses to address the assessed risk of material misstatement due to fraud at the assertion level. And so here in this explanatory material, they're giving us some examples of how we might accomplish that. So the first piece is that if we do have a risk of material misstatement due to fraud, this is higher than a risk or a normal risk. So that means that we need to change our procedures to obtain audit evidence that's more reliable and relevant, or we need to corroborate that information more fully than we would for just a normal risk. And so examples of where or ways that we might do that are below. For example, if there's a risk of material misstatement due to fraud in the entity's inventory, then we may decide to do a physical inventory observation as opposed to just looking at the records of purchases. If there's a risk of material misstatement due to fraud of misappropriation of certain of the entity's assets, we might decide to go inspect those assets out at their location, rather than just looking at depreciation reports or tying to the invoices of purchases. Also, as another example, if management has a big incentive to inflate sales, for instance, maybe to earn higher bonuses or to meet earnings figures and expectations, we might design more procedures to obtain audit evidence that's more reliable and relevant through confirming the sales amounts with the entity's customers, or even confirming the terms of the sales agreements, which might include the date, rights of return, and delivery terms. And this might help us to mitigate the risk that there may be fictitious sales or sales with the terms or the expectation that they will be returned after year end, so it looks like the current year's revenue is inflated. We might also corroborate some non-financial information with personnel. For instance, maybe ask the sales team if about the agreements and delivery terms, or about the number of widgets that they sold during the year, something like that. That way we get some corroborative information. So another example of how our procedures might change due to our assessed risk and material misstatement due to fraud include the timing of substantive procedures. Therefore, we might conclude that performing procedures near or at the end of the period better addresses the risk of material misstatement due to fraud, rather than performing procedures throughout the year. So, for instance, in our normal risk procedure, we might perform interim procedures and then just roll those forward to the year end, which would be an efficient way for us to do the audit. But if there's a big risk of fraud, maybe we can't do that at an interim period and just roll it forward. We need to actually do it at the period end. An example of that might be an inventory observation. Maybe we need to perform the inventory observation on December 31st, the client's year end, rather than maybe the end of October or something, and roll forward for 2 months. Another example, we might need to modify the extent of our procedures based on our assessment of the risk of material misstatement due to fraud. And that would mean that maybe we need to increase sample sizes or perform analytical procedures at a more detailed level than if it was just a normal risk. So in summary, these were all examples of how we might modify our nature, timing, and extent of audit procedures in order to mitigate our risk of material misstatement due to fraud, or mitigate our audit risk related to the risk of material misstatement due to fraud. And as it relates to inventory observations, we might get an entity's inventory records, and that would help us to identify which locations, if any, we would like to go visit and do a physical inventory count. So if there is a risk of material misstatement due to fraud at a particular location or with a particular product, then we might want to go visit that location and count and observe that inventory item or location on an unannounced basis, or to actually count all inventory locations. So another common assertion that normally comes with a high risk of material misstatement due to fraud would be accounts that require a lot of estimation or subjective decisions, and that might include asset valuations, estimates relating to specific transactions, for instance, acquisitions, restructurings, or disposals. Other significant accrued liabilities like pensions or post-employment benefit obligations or environmental remediation liabilities. And so our risk might also relate to significant changes in assumptions relating to these estimates. So we need to use the information that we've gathered throughout the engagement about the entity and its environment, and that way we can evaluate the reasonableness of these assumptions that go into developing these estimates, as well as the underlying judgments. Another good tool of the auditor is to perform a retrospective review of similar management judgments and assumptions that were applied in prior periods. So, for example, maybe receivables in the prior year had a significant allowance, and now we know, this following year, we know how much of those receivables were actually collected. So maybe we can do a retrospective review to see how close was that estimate in the prior year. And so this section has also provided us in Appendix B some examples of possible audit procedures to address the assessed risk of material misstatement due to fraud. And these also help us to comply with the requirement to incorporate an element of unpredictability. So let's go down to this Appendix B and take a look at some of the examples that they provide. Okay, so now we're down in Appendix B, where we have some examples of possible audit procedures to address the assessed risk of material misstatement due to fraud. And this is at the assertion level. And of course, our use of any of these is certainly dependent on, and will vary depending on the types or combinations of fraud risk factors or conditions identified, and class of transactions, account balances, disclosures, and assertions they may affect. But we can go through a few of these just to get a good idea of what we could do to respond to our risk of material misstatement due to fraud in different ways. And also we can remember the location of these examples in AUC Section 240. That way we can go back to it later if we do come across a high risk of material misstatement due to fraud and need some kind of guidance on what we should do about it. So we might visit some locations. We might require inventories be counted at the year end. We might alter our audit approach in the current year for an element of unpredictability. We might investigate some adjusting journal entries that look odd. We might look for related parties by looking at unusual transactions around year end. We might do some substantive analytical procedures at a really disaggregated level to see if the relationships between the different accounts make sense. We might interview some personnel about some areas that we think have a risk of material misstatement due to fraud, and so on and so forth. There's a lot of examples here, and you can go through on your own. There's also a section here for misstatements resulting from fraudulent financial reporting. This one that we just went through is at the assertion level, so these are at the financial statement level. And then, these hone in on the risk of material misstatement through fraudulent financial reporting. And down here, we have misstatements due to misappropriation of assets. So our risk assessment could involve misappropriation of assets risk, fraudulent financial reporting risk, or sort of an overall risk at the assertion level. And so this is a good resource for us to use as we come across various risk of material misstatement due to fraud in our audit.